the conventional wisdom is that equity in your home is money that you technically have. It's an asset you have, but it's all locked up. You can't access it. Or can you? Can you access that home equity and actually put it towards other things and do stuff with it? So today, Denny, let's talk about velocity banking and a couple other creative ways that people can tap into their home equity to do other stuff, like invest in other real estate or invest in stocks or whatever else that people want to do with their money that's tied up in their home equity. So velocity banking is a concept where instead of having a mortgage, a fixed loan against your home, you have a HELOC as your primary loan, but you use that HELOC as a rotating line of credit to pay your other expenses as well, your other living expenses. And then you have your paycheck, your direct deposit from your W-2 job, or however you get paid. You have that go directly towards your HELOC. So your home in some sense serves as your operating bank account rather than a normal checking account that the typical person uses.
So how are the interest rates on these HELOCs?
On HELOCs?
Mm-hmm.
Well, so right now they're typically in the 6 to 10% range. But part of the idea behind velocity banking is that you pay off your loan faster than a typical mortgage because you're having your direct deposit from your paycheck go directly to paying down your balance. And even though you're using that HELOC to pay your bills every month, you're still hopefully earning a lot more than you're spending, right? So every month you're bringing down that balance much faster than you would otherwise pay down your mortgage. But the other quirk to velocity banking and why this can be cheaper than a mortgage, even if a mortgage has a lower interest rate, technically, is that your HELOC payment or your HELOC interest due each month is based on the average balance throughout that month. So if you're having these big payments coming every 2 weeks from your paycheck to drop down your balance, and then only periodically putting expenses on there, you will actually have a lower average balance throughout the month because you're paying down that balance with these big paychecks, and then only adding in the expenses later. So that is one way that can work. And then of course that HELOC, you don't have to just draw on that for your living expenses. You can also draw on it to invest, whether that is stocks or heaven forbid crypto, or real estate or gold or whatever it is that you're interested in investing in. You can tap that HELOC to do that.
There's probably also tax advantages. I'm not a professional, but the interest and whatnot, correct? You think?
Yeah, you can deduct that interest theoretically on your tax return if you are itemizing your deductions, right? So yes, there are some tax advantages. Now, a lot fewer people itemize their deductions nowadays, given the much higher standard deduction. But yeah, this is one creative way to approach paying down your home debt faster while also tapping into your equity much more flexibly. You can draw on that HELOC at any time for any reason. So velocity banking, obviously we just did a very high level overview here. Go look it up on your own. And of course, there are plenty of people who are happy to take your money as consultants to help you set it up. But, obviously do your homework before going and actually taking one out. All right, let's jump into a few other creative ways to tap into your home equity to invest. So one of the simplest ways to do this is when you go to buy an investment property. Let's say you're trying to flip a house or buy a rental property. You can put your own home up as additional collateral instead of making a down payment. So let's say that you would ordinarily need to put down a 20% or 25% down payment on an investment property. You can go to the lender and say, hey, instead of this 25% down payment, you can take additional collateral by putting a second lien against my home. And that will protect you in lieu of a down payment. And instead of a down payment, you can lend me 100% of the purchase price
Well,
of this investment property. So that's one thing that we've seen some lenders, especially hard money lenders or portfolio lenders, they are often open to doing that. Of course, the downside there is you are putting up your primary residence as collateral on an investment property. So, there is a certain risk involved in
risks.
that. So,
Hmm.
yeah.
Hmm. You don't want to lose your home.
No,
No.
especially over an investment property that maybe doesn't go according to plan, right? So, anyway, that is one option on the table to tap into your home equity uh, and use it instead of cash, right? Instead of cash for a down payment. And that can be especially effective with flips since they're so short term. Most flips last 3 to 6 months. So, a few months later, you're back to having one lien against your primary residence. The flip has sold, hopefully for a nice profit, and you can go out and do it all over again. So anyway, that's one more creative option on the table. You can do serial house hacking. This is a strategy that we love. And Denny, you and I have actually interviewed people who have retired within 5 years of starting doing this. They've reached financial
Yes.
independence within just a few years of doing serial house hacking. And the way this works, for anyone who's not familiar with the term house hacking, you go out and you typically buy a small multifamily, a 2 to 4 unit multifamily property, which, by the way, does let you use a conventional mortgage loan. You can take out a conventional mortgage for a property with up to 4 units, and you can use the future rents from those other units toward your income
Live
for
in one
qualifying
unit.
for the mortgage when you go out to apply for a mortgage. So that
Make
those
sure
rents
that
boost your income.
you have to live in one unit. People
You
need to
do,
know that.
yes, you
Yeah.
have to live in one unit. And the idea here is that the rents from the other units pay for your mortgage payment. So you technically live for free in this property. You're not coming out of pocket every month for housing. And you can then take that money that you are saving on a housing expense and putting it towards other investments, stocks, real estate, whatever. Now, here's the thing. You do have to live in this property, but only for 1 year in order to meet the legal requirements for a conventional mortgage. After 1 year, you can go out and do it all over again. So imagine that you buy a 4-unit property, you move into 1 unit, you rent out the other 3 units. The other 3 units, their rents cover your mortgage payment and hopefully some repairs and maintenance. And with all of your savings from this, you save up a nice big new down payment over the course of that year. And then after 1 year, you go out and you buy another 4-unit property and you do it all over again. And in this way, you can add up to 4 units to your rental portfolio every single year. Now, the downside is, of course, you have to move every year. You have to actually, pack all your stuff and move every single year, which gets old pretty quickly, I imagine. As someone who has moved quite frequently over the last decade and has lived in several countries and just moved back to the United States, moving frequently does get old. But, it can also be fun and exciting. And if that is the price you pay for reaching financial independence in, 4 or 5 years, maybe that's a price worth paying. Theoretically, you could have 20 units after 5 years of doing this, 20 rental units.
And there are people that do that.
Absolutely. And not only do you collect the rental income from each one of these properties as you buy more and as you snowball this, but each of those properties appreciates over time as well. So 5 years in, that first property that you bought has probably appreciated quite a bit by that point. And then you could maybe tap that equity as well if you wanted to, for whatever purpose. So we love serial house hacking, but bear in mind that it does require you to move somewhat frequently. All right, you can also do a live-in flip as one other way of creating home equity and potentially living for free. So a live-in flip is exactly what it sounds like. You buy a fixer-upper, you move into it, and then you renovate it on your nights and weekends. And if you sell it after 1 year, then the gains get taxed at the long-term capital gains tax rate, which is, of course, nice. It's lower than the regular income tax rate, of course. If you live in it for at least 2 years, then your first $250,000 in gains are tax-free due to the Section 121 exclusion, the homeowner exclusion. Or if you're married, that 250 grand bumps up to 500 grand. So 250 grand per adult. So it's a great way to, go out if you're handy, if you like working around the house, this can be a great way to not only have some fun,
Right.
customizing a house and improving a house, but making some good money on it. Buying a fixer upper, working on it at your own pace, at your own leisure over the course of a year or two, selling with either lower taxes or tax free, depending on how long you hold it. And then those gains hopefully cover all of your living expenses for the last couple of years and then some. You walk out with some profits in addition to covering your living expenses. So,
You also have to be very mindful that, because I've seen this, where you buy something and you are handy, you look all through, you think it's all good, and then you start doing one thing and you realize something big is going on, and then your expenses are larger.
yeah, so that comes back to due diligence, right? I mean, before you buy any fixer upper or any home at all, for that matter, any property, make sure you do your home inspections. Make sure you walk through the property with a contractor or three. Get lots of quotes. Make sure that there's nothing behind the walls, God forbid. Make sure there's no structural problems, right? If there are any mechanical problems, you might have to put in permits. If you need to replace a mechanical system or anything like that. So and the other quirk here with live-in flips is that the property must be classified as habitable by the appraiser if you're going to get a conventional mortgage loan. So something to keep in mind. So this works really well for cosmetic problems, properties that are really outdated, they need to be completely overhauled, but which don't have any major mechanical issues. Some minor mechanical issues, as long as the systems are still functional, enough to be classified as habitable, that's okay. But just beware of that as you consider live-in flips. And then the final one here is live-in BRRRR properties. BRRRR stands for buy, renovate, rent, refinance, repeat. And the idea here, this is a real estate investing strategy where you're basically flipping houses to yourself. And you are renovating some fixer-uppers. And then instead of selling them once they are renovated, you refinance them and rent them out and keep them as a long-term rental. And the idea is that you can pull back out your down payment from these properties. You have $0 of your own cash tied up in them. And ideally, you pull out your closing costs too. So truly $0 of your own money tied up in these properties, but sometimes you do end up leaving some money in them. But in this way, you can recycle the same down payment over and over and over again, with a new property every few months as you buy fixer uppers, renovate them, rent them out, refinance, pull your cash back out, and just go out and do it all over again with the same down payment. So you don't need a lot of money to amass a somewhat large portfolio of rental properties. This is a strategy. This is a form of infinite returns that Denny and I talk about quite a bit, where there's no limit to the returns that you can earn on that same down payment, that same investment capital that you're just recycling over and over again, adding more and more properties to your portfolio. And Denny, you and I do this in the co-investing club with passive real estate investing. You can do the same thing on a slightly slower timeline where you invest in a syndication and the operator will renovate the property over the course of a year or two. They'll renovate the units as they turn over and put new renters in there at higher rent amounts. It bumps up the NOI, the net operating income for the property, which bumps up the property value.
And
And
we
then,
don't do a thing.
yeah, we don't have to do anything. We're just writing a check. And then at the end of a couple years, after the property value is bumped up because the NOI is bumped up, they refinance and they return some or all of our capital to us, even though we keep our ownership interest in that property. So we keep collecting cash flow distributions on that, even though we've gotten our investment capital back and we're going out and reinvesting it in other places. So, but anyway, so that's a long, we went a little bit of a tangent there. But live-in BRRRRs, you can do this yourself where you buy a fixer-upper and like a live-in flip, you move in, you renovate it on your own time, on your nights and weekends or whatever. And then once you have it, you do that over the course of at least 1 year because the occupancy requirement is at least 1 year, but you can do this with a conventional owner-occupied mortgage. You move in, fix it up, and then after 1 year, you rent it out and you move into another property, your dream home or whatever, but you keep that property, the fixer-upper, as a rental property. And you can refinance it at that time if you want and pull your down payment back out, maybe to use as a down payment for your new home or whatever, or another investment property. And in this way, again, you can recycle the same down payment repeatedly while adding properties to your portfolio. So let's give a quick recap of these. Velocity banking with a HELOC, putting your home up as additional collateral instead of a down payment when you buy a flip or a rental property. You can do serial house hacking, where you're buying properties every single year and then renting out the other units, live-in flips, and live-in BRRRR deals. Jenny, anything we missed? Anything you want to cover here?
I want to ask you about home equity loans as opposed to HELOCs.
Yeah, so with home equity loans, anyone who's not familiar with that term, it's typically people use that term to refer to a second mortgage, although it could be a first mortgage if you own your home free and clear. It just doesn't come with the flexibility of a HELOC, so you can't do that velocity banking. But yeah, you can absolutely go out and take out a second mortgage on your home to tap into your home equity. I'm not sure I would classify that as a creative way to tap home equity. It's kind of sort of the front line idea that most people come up with when they think about tapping home equity. But there's nothing wrong with taking out a second mortgage if the numbers make sense. If you're comfortable taking on the extra debt. It's a strategy that many people use.
That's great.
All right, well, guys, if you got something out of this quick episode, please subscribe to the show, pass it along to friends, family, colleagues, anyone who could stand for a little more creativity in their finances. And if you didn't get anything out of this episode, let us know. support@sparkrental.com. Let us know what you want to hear more of. And if you're interested in passive real estate investing, getting all of the benefits, the tax benefits, the appreciation, the cash flow in real estate without becoming a landlord, check out sparkrental.com. We have a co-investing club where we get together every month and we vet deals together and we go in on them together with relatively small amounts of money. And if you're not familiar with how passive real estate investments work, check out sparkrental.com/free. On that note, stay weird, unconventional investor.